What's up, everybody? I'm Chris Naugle from Money School, BYOB, and the Money Multiplier. And today, I'm gonna do something that a lot of people told me, don't do that. I'm gonna peel the curtain back. I'm gonna show you exactly how we design the policies to work for the infinite banking concept. I'm literally gonna show you the secrets of the trade so that you, the customer, or anyone who watches this knows exactly how this works and how we design what we call the machine to be used with the infinite banking concept. So in going through this, the infinite banking concept first needs to be defined, and then later I'll show you exactly how it works. So when we talk about the infinite banking concept, what is it? Well, it's simple. It's a process of you taking back the banking functions in your life. That's what the late R. Nelson Nash pioneered. He literally took what the banks were doing and brought it to all of us so that we literally can benefit from all the things that banks do to make money. But more importantly, what the late R. Nelson Nash did was allowed us to take back control of our money. And I can't think of a time that's more important than right now for you, me, and everyone else to take back control of their money, because this is where it gets fun. By using the infinite banking concept, you indeed will be in control of everything you do with your money. But while you're in control of your money, you're also gonna need a product. And that product, as I'm gonna call it, is a machine to run your money through. Why would we do that? Well, we want you to earn interest on your money forever. That's right. If Albert Einstein said compound interest is the 8th wonder of the world, then he went on to say that those that understand it earn it, and those that don't pay it. Ask yourself this question. Do you want to pay compound interest, or do you want to be on the side of earning it? I already know the answer. You want to earn it, which is why you gotta use this concept. And it involves one change. That's it. Just change one thing and all this works for you. What is that one change? It is simple. You're gonna change where this goes first. What is this? This is money. This is the money that you've been taught to work for every day of your life. But you see, that money needs to go to work for you, because you think that you just gotta go out and work for money, and then all of a sudden, you're gonna go spend the money that you worked for. Let's switch that around and do what the wealthy do, because the wealthy take their money and they make it go to work for them. Yes, they worked for that money first, but then the money starts to work for them. That is exactly what I'm gonna teach you, but I'm gonna teach you more specifically how to design the policy. Now, this is something that we do for our clients, and I would say we're one of the best in the industry at it. But I also want you to know specifically what's going on behind the curtain, because it's better for you to understand how we design the machine. And what is that machine? Some of you are asking that. That machine is nothing more than a specially designed and engineered whole life insurance policy from a mutually owned insurance company that pays dividends. Now, in there, I said one key word that got you thinking, oh no, and that was whole life insurance. But let me just do a little exercise with you. Forget about what I just said about the machine and about the specially designed whole life. Let's just talk about what it does really quick. If I asked you what the perfect place for your money to be in would be, in other words, if you could put your money somewhere, what would be the best kind of place to put it? Well, I get answers all the time of, well, I'd want it to be guaranteed. I'd want it to be safe, and I'd want it to be liquid. If I want to use it, I want to be able to take it out when I need it. Well, I wouldn't want to pay tax on the gain, so I'd want it to be tax-free. I'd want to be able to leverage that asset. And you might say something like, well, I'd love for someday my family to get this money on a leveraged up basis. In other words, I want this money to be a legacy for my family. But I don't want them just to get what I saved. I want them to have leverage behind that. You might also say, well, I'd like it to be protected against judgments and liens in case I got sued. And if you're really thinking about it, you would say, I want it to earn compound interest. But let's take that one step further. I want it to earn uninterrupted compound interest. In other words, I want a place where I can put my money, earn interest, let it compound, but still have access to take it out and use it without interrupting the interest that original money was earning. Now, I know that sounds crazy, But what if I told you that there is a place that your money can go to work for you and have all of that tax-free, uninterrupted growth? That money could be leveraged, that money could be protected against judgments and liens, that money would be able to be passed on to your beneficiaries at a lever up, like maybe 5 or 10 times. That money could be guaranteed to grow. Yeah. You know what all those things just described? A specially designed and engineered whole life insurance policy. So if you wanted all those things, well, all you'd have to do is change one thing, and that's where your savings goes first. And where would it go? You already know. A specially designed and engineered whole life insurance policy. But when you think about that, you probably think of the whole life policy that maybe your broke-ass brother-in-law tried selling you. Or you think about the whole life policy that Dave Ramsey and Susie Orman and so many others said, that's the worst place you could put your money. You know who else used to say that? This guy right here. That's right, when I was a financial advisor, that's what I told people. Don't put your money in a whole life, buy term because it's cheap, and invest the difference with me, because that's how I got paid. But you see, when I learned this, I learned it from an incredibly wealthy individual. And they told me all the things that it did, and then they backed into what it was. And I said, ain't no way whole life works like that. I know, because I'm the pro. I learned that the policy you're about to see wasn't a normal whole life policy. It was literally designed backwards. It was designed completely different than the regular whole life I knew about and the regular whole life that everybody says that they don't like. So that's my intent, to show you how to design an IBC policy that can be used for the process called the infinite banking concept. And once I'm done with this training, you will know exactly how we design these policies. But there's one other thing. In order to do this, there's one thing you must know. And this is, bar none, the most important thing. You must know what your needs and goals are. What exactly is it that you're trying to accomplish? What are your needs? What are your goals? What do you want to do with this? Because if you don't know that, it doesn't matter how good of a policy I design. If you don't know what your money problem is and how to solve it, well, none of this will work. So let's solve some problems for you. All right, so remember, the only thing you need to do is change one thing. That's where your money goes first. And if we're gonna put your money into a machine, that machine has to solve a problem for you. And in order for that machine to solve a problem for you, it has to be built for your problem. And because of that, we've had to come up with multiple designs to solve different problems. You see, back in the day when the late R. Nelson Nash pioneered this, he pretty much had one design, and that's what we're gonna start with. It was called the 60-40, and I completely understand why back then in the late 90s, early 2000s, this was the design. And even today, all those years later, this design is the workhorse of the infinite banking concept. It is one of the most efficient designs long-term, but it has some problems. And I've uncovered those problems, and I've identified that this particular design sometimes doesn't work for people that have really, really short-term needs and they need the most amount of money immediately in the first 30 days or in the first year. Why did I say immediately in the first 30 days? Well, let me explain that to you, because we're using a specially designed and engineered whole life, which is very different than a regular whole life that comes off the shelf. A regular whole life that you were to buy from your brother-in-law, your insurance agent, your financial advisor, or someone else out there, they would design it around a death benefit. And you would be paying for the death benefit first, and the cash value, well, it's a secondary. And because of that, you would have no cash value immediately in the first 30 days, no cash value in the first year, probably no cash value in the second year, and wee little bits of cash value in the third year. Well, if you're me or I'm you, I want my money and I want it now.
It's my money and I need it now.
You guys remember that? Well, that's what we got to do. So the 60-40 design is designed to give you money immediately and in the first year, but it's not going to give you as much as some of the other designs. But where's the advantage to the 60-40? Number one, it is bar none the most efficient design in all of the designs that we have. Now let me just go through and explain that, because I know some of you don't understand some of the things I said. I said 60-40, and I'm going to call this the Nelson-Nash model. 60% is the amount of your premium deposit that is going to go into a special rider within the policy. It is not going to all go to the death benefit. No, it's going to go into the paid up additions rider. So that's what the 60% is. The 40% represents the base. The base is what a regular whole life policy that your brother-in-law sells you is all that they do. This is the death benefit, the base part. So in the long run, it makes sense that that's the most efficient, but I'm just going to show you by the numbers. But in the short run, the 40% is not the most efficient. And here's what I mean. In the first year, what we're going to do with all these designs is we're going to start with a model. That model is based on a 45-year-old male. Me! That's right. I built all of these around myself. So I'm 45, I'm healthy, so those are some factors you need to do. If you're younger, your numbers might look slightly better. If you're older, your numbers might not be exactly what mine are. And if you're not as healthy, well, that will certainly change things. You see, in doing this, I had to do a disclaimer stating that the numbers I'm about to show you are based on my policy designs, which might vary from what yours look like. Yours could be better, or yours could be a little bit worse, but the other thing I want to do is all the numbers on this design, and that we're going to look at on all the designs, these are based on the non-guaranteed columns in the insurance policy illustration. Now, what does that mean? Well, let me define that. Insurance policies, whole life insurance policies, have two guarantees. Number one, they guarantee you an interest rate. So the interest rate on all the policies you're looking at, depending on the company that we use, is going to be between 2 and as much as 3.25 by today's numbers. And right now, we're May of 2023. But those interest rates never change for the rest of your life. So all of you might be thinking of that number and being like, well, I'm getting that in my savings account, which is quite bizarre because a couple of years ago, you got 0 in a savings account. And now maybe you're making 2, maybe you're making 1, maybe you're making 4. But I want you to know something, that your savings account cannot be compared to the whole life because the whole life guarantees you an interest rate for the rest of your life, and it never changes. Your savings account, your checking account, your money market, it fluctuates with whatever the prime rate is and whatever the Fed decides interest rates should be today. If interest rates are going up, you make a little bit more. If interest rates go down, you make a little less. And for quite some time, you made nothing. And it would have been much better to make something. So these policies pay a guaranteed interest rate, but the second guarantee they give you is someday when you graduate. It's just a nice way of saying someday when you go to heaven, when you die, however you want to articulate that, there will be a tax-free death benefit paid out to your family. Those are the two guarantees. But in these policies and with the mutually owned companies we use, and just so you all know, not every single insurance company has policies that we can use. These are very specific. I already said it. They're specially designed and engineered. So out of the entire universe of insurance companies, we use about 5 of them. And there's maybe 10 total in the industry that work for what you're about to see. The one I'm going to show you today, actually I'm going to show you 2 different companies, are the 2 main ones we use. We use them because they work the best for the infinite banking concept. And each one of these 2 companies have been around well in excess of 100 years. One is 128, one is 146 years. They both have paid dividends consecutively every single year these insurance companies have been in existence. I want you to think about that for a second. Because the only thing that makes this illustration, these numbers, non-guaranteed is the dividend, because it's the only moving part. But right now, the companies have always paid dividends through the Great Depression, through the Great Recession, through COVID. They've never not paid a dividend, not even once. So to look into the future and say, oh, they're not going to pay dividends, so we should look at the guaranteed column would be probably not the best advice. Because if they've always paid them, well, let's assume they're always going to pay them. Now, what I can't tell you is whether they're going to go up in the future, or stay the same, or go down. But if interest rates are going up, dividends usually follow. That's important. So that's the things I wanted to get out there from a disclaimer. Let's get into the numbers. If we take a 45-year-old male, myself, and we put $10,000 in premium deposits into this specially designed whole life, in this one, we would have $6,575 available in the first year. And you would have some percentage close to that number available immediately in the first 30 days. That's right. So if we wanted to put money into this and then take money out, we could immediately in the first 30 days. There ain't no whole life out there, unless it's specially designed and engineered, that will ever allow you to do that. But why is it that you're allowed to do that? Why could we put 10 grand in and take 65, 75 out in the first year or immediately in the first 30 days? It might be slightly less. Well, let me describe how these are designed. So remember I said 60% goes to this special rider, a paid up addition, and 40 goes to the base. So come over here and look at this. What that would mean if we were putting $10,000 in premium deposits into this policy, the base would get $4,000 of that $10,000. The paid up additions rider would get $6,000. Now, let me describe something about how agents get paid on life insurance. You see, in a whole life, the agent would be paid on the base. That's right. The base is how you get paid your commission. And it's why Dave Ramsey and Susie Orman say these whole life policies pay huge commissions. Well, if the base was $10,000, let me just assume that the commission rate would be 55% for the base, which means if you put 10 grand into the regular whole life that your brother-in-law sold you, that regular agent, your brother-in-law, would make about $5,500. Now, that's not a bad day in the office. But you see, if we only put $4,000 into the base, that reduces the commission by, yes, that's right, 60%. Because the 60% or the $6,000 that goes into the paid up additions rider pays barely any commission. How much? Between 1% and 2%, depending on the company. Now, because we put it into the paid up additions, you have access to over 90% of the money going into the paid up additions once the money clears. See, that's the secret. But why would your agent not want you to know this? Why would your advisor not want to design the policy this way? Well, because they would give up 60% of their commission. So go to your financial advisor or your agent and say, hey, listen, I want you to get me or design me a whole life policy, and it's supposed to be specially designed and engineered, and I want you to give up between 60 and 90% of your commission. Can you do that? I guarantee you that your advisor will say they can't. They might even say that's not even allowed. Where did you hear that? That is all lies, because I used to think the same thing. But you see, all it requires is your agent or us, because this is the policies that we design for our clients, to give so that you get. We give up commission by the way we design it so that you, the client, gets more cash value immediately. Not a bad trade-off, right? Because it's your policy, you should have access to more money right out of the hole. So if we design it 60-40, the nice thing about this design, and the reason Nelson Nash loved it, is it does not, in most cases, require any term insurance. Now, we're going to cover this in a little bit with these other designs, but the term insurance, think of that as a drag, okay? The term insurance has a cost, and the cost on a term rider, which is what we're adding on here, so let me just write that. This is not just term. This is actually a rider that's built into the specially designed whole life. And that rider is put on for one reason and one reason only. And I want to go deep into this because this will be the only time in this video I cover what they call the MEC 7 pay. Now, what is the MEC 7 pay? First off, it's not something you need to worry about. It's something that we need to worry about when we're designing your policy. The MEC 7 pay is an IRS test. It's basically a rule through the IRS that says, depending on the amount of money we want to put into one of these specially designed whole lives, we are required to have a certain amount of death benefit on that policy. So if we want to put 10 grand in, well, the IRS through the MEC 7 pay will say that we need to have a certain amount of death benefit for a period of 7 years, hence 7 pay. So if we're going to put 10 grand in for 7 years, they're going to tell us we need a specific death benefit on this policy. But see, a nice way for us to design a policy, if we wanted to put more money in with a different design, would be to put a term rider on for a period of 7 to 10 years, because then we can skirt around that rule with a lower cost death benefit. You see, this whole design works by efficiency. And efficiency means reduce the amount of cost, increase the amount of money we put in so that we get that compound interest with the dividends and interest the insurance company pays us. That's how you win in this. But with the 60-40, we don't need that term rider on there, which means we don't have any drag. The policy is the most efficient in the long run, but it's not the highest cash value in the early time. 10 goes in and we only have 65.75 to use. So we have our MEC rule, which is just the IRS rule, okay? That's all I want you to understand about that because you don't need to deal with it. In the 60/40 design, the death benefit on this plan in year one is going to be $161,295. So that's going to be our death benefit, and that death benefit is all base. So in the beginning, that's what hurts you, but in the long run, that's what helps you. Now let me quickly describe something and explain the difference between base and paid up additions in a very simple explanation. So what we're looking at here is my definition of base versus paid up additions in the form of a rocket. Now all of you have seen Elon and SpaceX and other rockets launch off into space, right? When you look at that rocket sitting there getting ready to launch, you got the main fuselage, you got the main rocket, which is the base, okay? And then on the outside of the rocket, you've got booster rockets, okay? The booster rockets are the PUA. So these are your boosters. Now, in order to get this rocket into orbit, we need a whole lot of horsepower, a whole lot of thrust right out of the gate. And that's what the booster rockets are for. 3, 2, 1, and these booster rockets blast a ton of thrust off, getting this rocket off the ground, which is the hardest part because there's zero momentum. There's no velocity behind that rocket. It's just sitting still. Once these booster rockets get this rocket into orbit, and all of a sudden, when it's in orbit and you're looking down, this is sort of what the Earth looks like. It's just this tiny little thing. What does the rocket do? So when the rocket gets into orbit, the rocket no longer needs the thrust of those inefficient booster rockets because those booster rockets, they use up so much fuel. So the booster rockets, literally, all they do is they get released from the rocket and they fall back to Earth. Elon has even figured out how to land these booster rockets on a barge in the middle of the ocean. But now, this thing is in the middle of orbit and it kicks up its main rocket, its base. This rocket is the most efficient. It burns the least amount of fuel. It goes the fastest. It is single-handedly the most important part, which is why this is where all the little people sit in. The people aren't in the booster rockets because the booster rockets, they get let off. They fall back to Earth. You don't want to be on the booster rocket. They are inefficient, but the base is the single most efficient thing. But you see, the base can't work. The rocket can't work and get into orbit without the boosters. That's exactly what I'm talking about. So base equals the main rocket. It's efficient performance. Paid up addition rider equals the booster rocket. Maximum thrust. It's not as efficient and it falls off when in orbit. In our case, we're going to get rid of the paid up addition riders either in the 8th or the 10th year on every design, which you're about to see. The term rider, which we haven't talked about yet because in the 60/40 we didn't need the term rider, but I want you to think of a term rider as this up here. It's this super inefficient thing that they just had to stick right on the part of the nose of the rocket that drags. So when this thing's blasting off, it's got wind hitting this, creating drag. That's the term rider. Hence why Nelson Nash in his original book, Becoming Your Own Banker, and with everything we teach, we typically want to reduce the amount of term. Because if we don't have term, well, it's just like every fast car and every rocket you've ever seen, it has no drag. It is completely aerodynamic, but in some of the designs you're going to see next, we need that term rider because of the IRS rules, so we will have some drag. I just wanted you to understand exactly what a paid up addition rider is. It's the booster, and the main base, which everybody says is the bad part, is the most efficient in the later years. Typically, anytime after the 5th or 7th year, the base becomes your most important thing. That's important. I want you to remember that. So real quick, let's just go a little bit deeper into the Workhorse, the Nelson Nash model being the 60/40 design. The first year, remember, we're going to sacrifice some of that early cash value for later cash value. We're only going to have access between 60 and 65% as this model shows. The 5th year, these are the cash values on the left side, and all these designs, the left side represents the cash value in the policy. Now let me be clear. This cash value is what's earning interest and dividends from the insurance company. But if I was to take this money out, let's just say in the first year I take $6,575 out, I would take it as a loan from the insurance company. Because what the insurance company is going to do is the insurance company is never going to take any of my money. My $6,500 is going to serve as collateral for the loan that the insurance company gives me. But the loan the insurance company gives me is a loan that really never needs to get paid back. I'll get into that later, but I want you to think about that. You're probably in your mind thinking, wait, what kind of a loan never needs to be paid back? How about a loan that will be paid back the day you die? Because when they give you a loan against your cash value, what they're going to do is they're literally going to come over here to your death benefit that they have to pay. Remember, it's guaranteed that the insurance policy has to pay a death benefit the day you graduate, the day you die. I just don't like saying that word. So if they give you a loan of $6,575, really what they're doing is they're just advancing you $6,575 of your death benefit while you're living. And then just using your cash value, which is still compounding uninterrupted, as collateral. Does that make sense? Because that's really one of the most important things about why we use a specially designed whole life instead of anything else. We don't use IULs, we don't use VULs, we don't use stock accounts. We use specially designed and engineered whole life because that is the only product in the world that can do what we need. It's the only one that can provide us uninterrupted compound interest on a guaranteed basis without having any movement in costs within the policy. The only moving part inside of a whole life policy is the term rider. But the 60/40 doesn't have a term rider in most cases. So therefore, as we keep going, you can see in the 5th year, we put in $10,000 and we can now take out $10,122. The first year we put in 10 and we could only take 65.75. And each year that goes by, I'll just give you a few of those numbers. The second year, we put in 10 grand and we can take out 85.83. See how it's getting better? Year 1, 65. Year 2 is 85.83. Why would it have gone up? Compound interest on an uninterrupted basis. The interest you earn plus the dividends, compounding. Year 3, we put in 10 grand and we can take out 9,050 in this design. Year 4, 10,000 goes in, 95.41 comes out. See how it keeps climbing and climbing? And then in the 5th year, like you're seeing here, we put in 10 grand and now we can take out more than 10,000. Now here's the cool part. We call this the efficiency zone. I love this because at this point in this design, every year for the rest of my life, whatever I put into this specially designed whole life, I will have more money than I put in to take out in that next year. That's always going to happen. And every year it's going to get to be more. Look at this. The 10th year, I put in 10 grand and I can take 13,184 out. I want you to think about that. If you took 10 grand and you put it into an investment, and at the end of the year you took 13 grand out, how much did you make? 30%. You would have made a 30% cash on cash return in the 10th year. But every year it gets even better. You see, in this policy design, one thing I want to be clear about. Remember I said we got to get rid of those inefficient rockets, those booster rockets, those paid up additions. So in the 10th year, that's the last year we're going to keep those booster rockets on. Because every year thereafter, we're just not getting the efficiency. So we're going to drop them. You can see in the 11th year, let me just kind of tell you, in the 11th year, this policy, the most amount of premium deposits you can put into the policy is $4,000. You can no longer put $10,000 in because of the IRS rule, the MEC 7 pay rule. We dropped that paid up additions rider, so now the most we can put in is $4,000. So in the 11th year, I put $4,000 in, I can take $4,615 out. In the 15th year, I put $4,000 in, I can take $9,505 out. Just let that sink in. You put $4,000 in, and in the same year, you can take $9,505 out. I hope that's what just happened. And what if the next year it got to be more? And the next year was more? Because it goes from $9,500 to $9,800 to $10,280 to $10,701. If we get to the 20th year, we put in $4,000 and we take out $11,606. Remember I said the base is the most efficient part of the policy design. You are seeing that in action. Now that we have gone through the plan design, how it works, what it does, the one thing I wanted to show you is the commissions. You see, this is the part that your agent doesn't want me to tell you about. This is the part that your advisor and your broke-ass brother-in-law doesn't want you to know. Because they don't want you to know how this works, because once you know, they have to give. And what do they have to give? Well, let's just say your brother-in-law designs you a whole life and says,
oh, this will work for the infinite banking concept. This is going to be fine.
Or, worst case scenario, they put you in an IUL. I'm not even going to get started.
Oh, this is going to work for the infinite banking concept.
No, it won't. See, they're going to put your money into the base. And if they put your money into the base, $10,000, even if they were at the low scale, because the commission scales vary. So this is a sliding scale, whether it's a regular agent who just started or somebody that's been in the business a long time and has their own GA, the commission structure can go anywhere from about 55% to as much as about 90 to 100%. That's right. Whether it's an IUL or a whole life, that's about the same, but an IUL pays even more. So that's why your broker wants you to buy an IUL. It's the highest paying commission in the industry. Whole life, not so much. And specially designed whole life, well, that one probably pays the least amount. So let's come over here and talk about how much commission this design would pay us if we designed your policy for you. Because by now, you're probably thinking, well, you guys should just design my policy since you know how to do it. Well, you're right. We should design your policy. Your brother-in-law, your financial advisor, or your current agent probably should not, because they're not going to know how to do it in the first place. Even if they watch this video and learn, they're probably not going to want to do it because they don't want to give up their commission. Because if they made $5,500 on you, that's a good day in the office. But if they design it this way, their commission would roughly be about $2,403. Now this is a estimated commission, so this will be different, but I'm just trying to pencil this out. This includes the commission on the base at 55% and the commission on the paid up additions, I figured it at 2%. Okay? So the combination of the base commission and the PUA commission means that this policy design would pay $2,405. But you see, if they just designed a regular whole life or a regular IUL, their commission would be way more than that. Their commission could be something like $5,500. If it's an IUL, it could be 120% commission. They could make $12,000 on your $10,000 premium. Now do you see why they want you to buy IULs? This is specially designed and engineered so that you win. Not saying we lose, because that's not a loss, but that is significantly less than $5,500. So I give so that you get. And that's exactly what we're talking about. So let's carry on. Now that you understand what's going on, let's move a little quicker. Let's go on to another design. And remember I said all of our designs are built to solve a specific problem that you, our client, has. So this one is sort of the all-around. It will solve just about every problem. The only problem this one suffers with is a very short-term problem. Let me give you an example. Let's say you're a real estate investor and you want to buy a property. The second your policy funds, you're going to take that loan out immediately in the first 30 days and go buy a real estate property or lend that money out. If that was your objective, well, you would want more than 65, 75. You'd want the most you could get, right? So let's move on to product and plan design number 2. And remember, I'm only talking about the machine, the product. We haven't got into the concept, the process, which is really what matters, and that's the infinite banking concept. Because these products, all these are designed to do is to solve your problem, but the infinite banking concept is the process. See, after we change one thing, and that's where your money goes, the second thing we're going to do is we're going to add one step to how your money works for you. Hear what I said? How your money works for you. And when we add that one step and we change where your money goes, you are now 100% in control of your money. That should be music to your ears right now. In light of bank failures, in light of Wall Street taking a big drop, and probably will go down a lot more, you're probably looking for guarantees, safety of principal and preservation, liquidity of your money so that you can take advantage of opportunities when pricing goes down, and you want to control it all. Just like Apple, end-to-end control. We're going to do the same thing with this. But if your goal was you wanted more early cash value, we would move you over to this design. Now we've got nicknames for all of our designs. And some of our designs, in full transparency, some of the things I'm going to show you are proprietary to the Money School and the Money Multiplier. They can't be designed by any other agent or agency. Why? Well, because we've gotten to a certain point where we have the ability to design plans that nobody else can with these carriers. This is not one that's unique to us, but this is one that not a lot of other people are doing. This one takes, out of the $10,000, we're going to put 75% of your money to the paid up additions rider. And we're going to take and put 25% to the base. You see how all we're doing is we're shifting and putting more to the paid up additions than we did before and less to the base, reducing the main rocket, increasing the booster rocket, because we need more thrust early on and we're not as concerned about later efficiencies. In this design, we're putting 75% of your premium deposit. Let me just hit that real quick. You keep hearing me say that. When you think of a whole life insurance policy, you think of a premium being an expense. I don't want a premium, I don't want an extra expense, don't you? But when you think of your deposit that you make into your bank, you walk into your bank and you're like,
oh man, I'm so excited, I got myself a deposit. Hey, Mr. Bank Teller, I want to make a deposit today.
and you slide that money over and the bank teller looks at you, says,
How are you doing? Would you like a sucker?
and you know what, you're thinking you're in a good mood, you're making a deposit, you're thinking,
Yeah, man, I definitely want a sucker. What do we got?
you look up in that little cup and you got yourself
Some strawberry, some grape, you got some lime. Oh, we got a rat. Okay, I'll take the raspberry.
and you grab the sucker, and without even paying attention to the wrapper, you unwrap it and you start enjoying the sucker. But as you're waiting for the teller to make your deposit, you look at the sucker that you just started enjoying and you look at the wrapper and it says, Dum Dums. Now you may or may not really think about that, but there's a hidden message in there. There's not a bank that I've ever been to in this country that doesn't have one type of sucker, and that is Dum Dum suckers. That's right. You now, by making deposits in their bank, have given them the ability to make your money go to work for them. They just take your deposit, they do not put it in the vault with your little name taped onto it. They take your deposit and they make that money go to work for the bank. They lend it out, and they lend it out at a much higher interest rate than what they're paying you on that. In other words, you worked hard for your money. You then gave up control to the bank. The bank now is in control of your money, and the bank makes your money go to work for them. And all you get is you get a measly little interest rate that will vary and fluctuate and change just like it has every other time in history since banks came into existence. But you enjoyed making that deposit, which is what that story was. So when you're making a deposit into your specially designed and engineered whole life with the effort of you creating your own banking system. So what we're actually doing is we're creating what the wealthy call private banking. We're creating your own private bank. That's right, because that's exactly what we're doing here. By creating this policy to then be used with the infinite banking concept to take back control of all your money, make your money work for you, you are indeed changing who the bank is. You are performing what we call BYOB. Be your own bank. So when you make a deposit into your bank, which just so happens to be a specially designed whole life, we can't call it a premium because a premium, in your mind, you think of an expense. So we call it a premium deposit. Sorry I went so long with that, but it's important that we realize in learning how to be your own bank, you change the way you think about money, and you change the way you think about everything you've done with money up to this point. 75% goes to PUA. So we're going to put 7,500 there. 25% goes to the base. So now we've changed the dynamic of it. But in doing this, unfortunately now, because of the MEC 7 pay rule, we have to add term insurance. So we're going to add a 10-year term rider. Why? Because I don't want it after the 10th year. Because remember that rocket with the drag? I don't want drag. So what's the soonest I can get rid of it? The 8th year. But I'm going to keep it on for 10 years, and I'll explain why. But this 10-year term rider, we're going to have to add this rider, and this rider is going to be for $100,000 of death benefit. And that $100,000 of death benefit is going to have a cost for me, because this is my policy design, of about $196. So this is the drag. Now, this design is pretty efficient because it doesn't require a ton of term, which is why we like it. We get more early cash value without having a whole bunch of expense. Another design we're going to talk about in a little bit is going to have a lot more term because we need it to support the IRS rules, which means this policy in year one is going to have a death benefit of $160,843. So the only difference between the 60-40 and the 70-25 is we now have had to introduce a term rider. So let's go into the numbers, but let's go quick. Remember, we're still putting 10,000 in. But once we put the 10,000 in the first year, we have $76.91 to use. If we want to take a loan immediately in the first 30 days when your check clears, we're going to have slightly less than the $76.91, but close. It's just going to be that minus the interest and the dividends for that year because it's immediately. But in the fifth year, we put in $10,000 and we can take out $10,573. See how that's a little bit better? We're actually growing more. Why? Well, because we have more money compounding. We've lost less to the cost of insurance, therefore we have better growth in the early years. In the 10th year, we put in 10 grand and we can take out 13,477, slightly better than the 60/40. But then after the 10th year, something happens. After the 10th year, now we can only put $2,500 into the policy. Now, why is that a bad thing? Well, let me ask you something. If you had the ability to put $4,000 into the policy, okay, here, in that first policy design, 60/40, and this will be the last time I go over this, but in the 60/40, we were able to put $4,000 in the 11th year. And if we put 4,000 in, we were able to take 4,600 out. And as we got to the 15th year, we put 4,000 in and we were able to get 9,500 out. Now in this policy design, after the 10th year, we can only put 2,500 in. Now, if I'm a logical thinker, at the point when I'm at the 10th year, and this policy is the most efficient, because remember, that's when the rocket's the most efficient, anytime after the 5th or 7th year, depending on the design, that's when every dollar I put in, I'm taking more out than what I put in. So wouldn't I want the ability to put more money in if I can take more money out? I'd want the maximum amount to be put in. I'd want to put the most that the IRS allows me to put in if I always know that for the rest of my life I take out more than what I put in. But you see, by doing this design, which gets me early cash value, I give up long-term ability to make more money. Because now, in these later years in this design, the 11th year, I only can put 2,500 in, which means the 2,500 allows me to take $4,000 out. In the 15th year, I put 2,500 in, and I can only take out 8125. In the 20th year, I put 2,500 in, and I can only take 9,800 out. Do you see what I'm saying? This policy is more efficient for the long term because I have the ability to put more money in at the most efficient time. As we keep going, we're going to be able to take out less and less in the later years because we can put less and less in. But we gained a little in the early years. So depending on your needs and your goals, that's what determines how we design your policy. Now, over here, let's just talk about the commission, because now in this policy design, the commission is going to be slightly less than it was in the 60/40. So if I take the base, now I'm only getting paid the 55% on 2,500 and roughly about 2%, give or take, depending on the company, on the 7,500. So my commission on this one would be roughly $16.28. Okay, that's about how much my commission is, which is a little bit less than the 60/40. So because it's a little less, that's why you have more in the early years. So that's how the 75-25 works. We call it the beast, and we love this design for people who want higher early cash value early on, but they still want to maintain some efficiencies in the later years. The next design, this is a unique design. This design was put together for us. It is called the Slayer. Why the Slayer? Well, because it slays. So in this design, what we're going to do is we're going to switch it up. We're only going to put 65% to the PUA, and we're going to put 35% to the base. Now, in just a second, I'm going to show you where this design is absolutely used for almost everyone that needs high early cash value, because it does something that we weren't able to do with the 25-75 design, is it allows us to dump more money in. But in this example, I'm only showing an example of $10,000 in premium deposit going in, so I wouldn't typically use the Slayer design. I would typically use the Beast for someone that wants high early cash value in this, just to give you an example. So here's how this one works. We put 65% into the paid up edition, so let's just change the number, and then we put 3,500 into the base. So now what that's going to do is that's still going to require us to have some term insurance on this plan. So how much term do we need? Well, now that 10-year term rider, we only need $75,000 because we've got more in the base, which means our term rider is going to cost less at $159. So again, that's the drag. I just want you to always think of the term as the drag. We don't want term if we don't need it. But in this case, in every other one of these, we need term insurance because of the MEC 7-pay IRS rule. So over here, let's get rid of the commission on the old one and the death benefit. So the death benefit on this particular design isn't too bad, but it's a little less at $152,835. Now let me talk to you a little bit about something on the death benefit. Every one of the designs we will ever build, I don't care what it is, every year you put more money into the paid up addition, your death benefit will go up. Because as your cash value goes up, your death benefit has to go up. You can never have more cash value than you do death benefit. If it did, that policy would become a modified endowment, which we don't want. So every year we put money in, the death benefit goes up. Let me just give you an example. In this Slayer design, we start with $152,835 in death benefit. The second year we put another 10 grand in, remember, in that second year your death benefit isn't 162, it goes to 167,008. And that's gonna keep climbing all the way until I get to the 11th year. Now in the 11th year, what I'm gonna do is I'm going to drop the term rider. So 11 years in, the term goes to 0. Okay, we following on that? So when that happens, my death benefit in the 10th year was $295,000. You see how that went up? We went from 152 to 167, and 10 years later, we got $295,869. Now that's building a legacy, but it's building a legacy while putting you in control of your money. But when we drop that term rider, we go from 295 to down. Now the death benefit in the 11th year drops down to 268. Okay? See what happens? The term rider gets dropped, our death benefit drops. It's all relative to one another. The commission on the 65-35 is going to be very similar to the 75-25, and the commission on this policy with the paid up additions works out to be 2139.25. If this money was put into that regular whole life, remember it would have been $5,500, which means that's $3360.75, so $3,360.75 that we give up so that you have access to it. I just want to be clear what's going on here. Now, let's just quickly dive into the numbers because these are fun, and I'm just going to go quick. Year one, out of the 10 you put in, you had $69.57, slightly less than the $75.25, but slightly more than the $60.40. Year 5, we put 10 in, we can take $10,287 out. Year 10, we put 10 in, and we can take $13,299 out. I put 10 in, and I can take $13,299 out. That is the stuff that gets me excited. And every year, the year 15 or year 11, we drop down to $3,500, because remember, only 35% can go in, and that's the base. We can't put any more money into the paid up additions. So that's $3,500. So that $3,500 in the 15th year is $9,052. And in the 20th year, I put $3,500 in, and that's $11,042. Every year, you're going to have more money than you did the year before. Every day, you'll have more money than you did the day before. That's how this works. The only give is the first couple of years, you'll have less money than what you put in because there's not an insurance company that's a nonprofit. Most of the insurance companies are for-profit companies. So there's a cost for that death benefit. And if that death benefit cost doesn't benefit you, if you don't care about anyone else on this planet, when you leave and graduate, you don't care that anyone else gets a death benefit or gets something that makes their life better, well, then this concept and this product is not for you. It's that simple. But if you do care, well, then the first couple years where you're putting money in and not able to use it all, that is what you give up so that for the rest of your life, usually after year 5 or year 3 in the designs that you're going to see now, every year after year 3, you're going to make more money than what you put in every year for the rest of your life. Uninterrupted compound interest guaranteed. That's it. So that's the 35-65. And that leads me to the very last design. Now this last design is a controversial one. If you talk to the Nelson Nash Institute, they don't even want their IBC practitioners talking about this design. But it is important for me to talk about it because there are other shops out there and other agents out there talking about this. And there are some people saying, oh, this is the best one, there's none better. I couldn't disagree more. This design is not the best design all around. The only thing this design is going to be best for is the high early cash value in the first couple of years. Because to design this policy, what we're going to do is we're going to shift everything. We're going to literally redline this engine. Now, let me ask you guys a question. in your vehicle that you have, if you just put the accelerator all the way to the floor and you get that tack red line, what eventually happens when you redline your car? You hear some funny noises in the engine, maybe see some smoke, and eventually your engine no longer runs. Because we're redlining this by putting 90% into the paid up additions and 10% to the base, so now out of the 10,000, we're putting 9,000 to the paid up additions and only 1,000 going into the base. We literally have now designed a rocket ship that kind of looks like this with these giant boosters. That's actually pretty funny. I've never drawn that before. So here's our booster rockets and here's our base. That's kind of what it looks like. So this thing gets off the ground super fast and this thing rockets into space. And when it's in space and it drops its booster rockets, well, hopefully for any of you men, when you look in the mirror, this is not the vision you get. This is not an efficient rocket. This is a failed rocket. But that's what we're designing. We're designing a rocket. We're designing a machine that will work really well in the early years, but will suffer in the later years. Let me show you. In the early years, we're going to put the $9,000 into the paid up additions, which means we get $8,830 to use immediately. By far the best. You know, slightly better than the 75-25, much better than the 60-40, and this one's just in the middle. We'll come up to where the Slayer really makes a ton of sense. But in the 5th year, we put in $10,000 and we can take 11,000 out. So 10-5-20, 10-287, 11,000. You can see it's still better in the 5 years. The 10th year, we put 10,000 in. We take 14 out in comparison with 13, in comparison with 13-477. Not too much better. See how we're losing efficiency as we're going deeper and deeper into that? But see, here's where something miraculous happens. And this is something in transparency I want you to understand. These numbers here in the cash value look slightly better, but also we're putting an extra $378 in. We're not just putting 10,000 into this one. See, this one, in order for me to make this illustration work, I had to do $10,378. So right off the bat, I made this policy look better because I had to put more money into it. So I want you to understand that. But see, now, once we get down here to year 11, the most amount of money I can put into the policy is right there. $1,378. So in the 11th year, I can only put $1,378. And I'm actually going to change up this number here because now my base is $1,378. I'd have to modify the numbers. I'm just trying to keep this simple. So now when I put $1,378 in the 11th year, I can take out $3,646. By the 15th year, I put $1,378 in. Remember what we said earlier? We want to put the most amount in the later years when the policy is the most efficient. I literally just cut my arms off here because now the most I can put in under the MEC rule is $1,378, which means I'm going to get less back. The returns are probably really good, but I get less back. Less money to use, less money to lend, less money to buy cars, less money to pay off debts. But I gained in the short run. So the 1090 or the 90-10 as it's called would be great for people that want really high early cash value, but you have to understand what you're giving up in the later years. And the other thing you must understand, to design this policy to work within the MEC rules, it required a much larger term rider. The term rider on this is more than any of the other ones at $150,000 in term rider. And we do a 10-year term rider, which is going to have almost double the cost. Okay, so our drag is now $294 for a period of 10 years, which is why you saw the policy losing efficiency in the later years. But some would argue and say, yeah, but I had more money to move and use earlier, and the money I'm making on that money working for me outweighs anything in the later years. True. Stay tuned, because in a moment I'm going to show you the best of both worlds, which is a proprietary design to us, and we call it the Rock. But let's just get through this. So now my death benefit on this policy is $192,417. But remember, a lot of that, 150 of that 192 is term. And in the 11th year, I'm going to drop that term rider because I'm going to drop the paid up addition. So the term in the 11th year is gone. We get rid of it. Okay? And you don't have to. You don't have to get rid of the term. And some people that design 90-10s will say, oh, no, you just keep the term on. Let me remind you something. Every year that you get older, your term rider gets more expensive. Did you hear me? Every year after the 10th year, because it's a 10-year term rider, every year after the 10th year, your term gets more expensive. So as you get older, your cost goes up every year until the day you die. So that drag on your policy gets bigger every year, and there's nothing you can do about it. So why would you want to keep the term rider on the policy if we're trying to make it the most efficient policy we can? You wouldn't. But because we dropped the term, here's what happens. The death benefit in the 11th year, so in the 10th year, the death benefit was 300, let's get to that, 10th year, 363,940. And it's more than the other ones in the 11th year because we've been throwing so much money into the PUA. But then once we drop the term rider, we drop down and we're only going to be 220,146. So we've given up death benefit, okay? We've given up efficiency, and now we have less money that we can put in at the absolute best time to put money in the policy. But there is one other underlying thing about a 1090 or a 9010, depending on how you're calling it, that most won't tell you. Because we've got so much money redlining into the paid up additions, if dividends start going up, we're going to hit our MEC limit sooner, which means we're not going to be able to put as much money in for the period of time that we were hoping. And because we're in a rising interest rate cycle, the chance of dividends going up over the next few years is actually really high. So if dividends go up, we're going to have problems with this policy. We're going to have MEC problems. We're going to have to look at this policy and redesign it or put less money in it, and that's going to hurt your plan. So we've covered the first round of this video, and I've dissected everything about the infinite banking policies, especially designed and engineered whole life. But the other thing that we see a lot of is we see a lot of clients that have some money that they've been saving somewhere else. Maybe they've been putting money in a 401k, maybe it's into a savings account, a CD, a money market, and they hear about this and they're like, oh, well, wouldn't it be better to take this chunk of savings and dump it into the policy? Oh yeah.
Oh yeah.
And if you do that, you make this whole thing work way better. So let me show you that. So as we go into this next part of this video, I'm going to now show you the exact same thing we did just a second ago, but now we're going to assume that some of you have some extra money just laying around in someone else's bank. And you want to change one thing, and you want to take that savings and you want to put that into your bank, which is the specially designed whole life. Now to do that requires some different designing. Because as we dump money into a policy, we now have to increase the amount of death benefit to support the MEC rules, because you already understand that. So now let's just look at these different designs, the same exact designs we did a second ago, but let's look at them with a dump in. We're going to assume still a 45-year-old male that's in good health, because these are on me, and we're going to assume that I'm going to dump $50,000 in right off the bat. All we're going to do here is we're literally going to assume you've got some money saved in an account somewhere, and you want to take the money out of that account, this hand, and we want to put it into this hand or into this pocket. This pocket where I just put the money is a specially designed and engineered whole life. In this business, what we do is we call that a dump in. All of these designs assume a $50,000 dump in, okay? With one major exception, the 90-10. The one that was best for high early cash flow, the one that a lot of people say is the best design for everything. All of a sudden, now once I want to dump money in, this becomes by far the worst plan because we can't build this plan to hold $50,000 with only $10,000 of premium. But why would I want to do 50 and 10? Because the bigger the dump in relation to the amount of base and premium deposits, the more efficient the policy. Just think of that rocket. We want the base to be the majority of it, and we want the booster rockets to still get us into space as quick as possible. But now when I dump money in, I increase the boosters, okay, because I put more money into the boosters. But I won't need the boosters in the later years because I don't have to sacrifice the base. The 90-10, that small little fuselage, that small little rocket, can't hold it. It's just not built for that. So as we get into this one, I just again want to give you a disclaimer. This example uses non-guaranteed cash value. Dividends are not guaranteed. Values, performance, ratings are subject to change based on your particular situations, and they may differ from what I'm showing you here. In other words, what I'm showing you might differ from what you have. But let's go into this. I dump in 50 grand into the 60-40, Nelson Nash's model, plus I put 10 grand in. So I put 60 grand in, now I got 54,500. Whoa, that looks a lot better than before. Correct, because what I just did is, although the 10,000, I put the same thing. I put 4,000 into the base, 6,000 into the paid up additions, but then I dumped an additional $50,000 in that dump-in into the paid up addition. Now I built what I would say is almost one of the most efficient vehicles for the infinite banking concept. And you can see it. Year 5, the first year I put the 50 plus the 10, so I got 60 grand in, I can take 54 out. Year 5, I put 10 in, I take 11 out. But here's the cool thing. The efficiency moves up. So the year that you put money in and the year that you can take more than you took or put in out changes. In this one, it's year 3. In year 3, I put 10 in and I can take out 10,301, which means every year in this Nelson Nash design, every year after the 3rd year, what I put in, I'll take out more than what I put in. That's amazing. And it gets nutty because I can still put 4 grand in after the 10th year. So in the 15th year, I put 4 grand in, I take 12,000 out. Hold on, 4 in, and I take 12,511 out. I did that before. Yes, I did it again. Even in the 10th year, I put 10 in and I take 14 out. That's a 48% cash on cash return. Do you see the difference? You see how valuable it is to dump money in early? Because all of that money is earning uninterrupted compound interest. Doesn't matter if the money's in the policy or if you've taken it out as a loan. I could put 50 in and take 50 out and lend it to Jordan here recording me right now. And Jordan then pays me 12%, but I still make interest and dividends on all $54,500. That's how this works. We'll cover that in a second. So let's go quicker. Now the 75-25. What happens with the 75-25? Well, let's go into that one and I'll dissect it a little bit more this time. The 75-25, remember, it had higher early cash value early on. Same thing, I put 60 grand in, now I can take 55 out. See how it's a diminishing return. I don't get as big of a bang to my money as I did before because I got 54 out of a 60-40. Here I only get 55. The 2nd or the 5th year, I put 10 in, I get 12. 10th year, 10 in, get 14. Not a big difference. Do you want to know why? Even though I reduced my base down to 25, which means I reduced my cost, and I increased the paid up additions, plus I dumped the 50K in, the 50K required me to buy more term insurance. So now that term rider is now $550,000. And that $550,000 term rider cost me $940.50. Drag. This is a drag on your cash value. You're seeing it firsthand. There's your drag, 14,818. Even though the design is much better for early cash value, it's not when we dump money in because we lose efficiency at a rate of 940. But then once we drop the term rider in the 10th year, now all of a sudden, the plan gets to be more efficient again, which is why down here we put 2,500 in and we take 18,000 out. So you see, you're gonna really benefit on this plan from an efficiency, but after the 10th year with dump-ins. So a lot of times this design will be used, but usually I'll use the next one. So let's go to the next design. We call this the Slayer. Almost 100% of the time, the Slayer, by a long shot, is going to be the most efficient design when we're doing a dump-in. We can shove the most amount of money into the policy without having to deal with high term riders. Like, we don't need as much term rider because remember, now we've got 35% to the base. It's not as good as the 40, but we've got 5% less. That little 5% less requires less term, which requires less drag, which usually makes this policy work extremely well with dump-ins. The numbers in this one definitely show that it's going to trend very heavily with the Beast. The Beast was the 75-25. Our numbers are almost identical. We put 10 in the 10th year. We took 14,993 out of the Beast. And down here, we put 10 in and we take 14,872 out. Now, in this particular design, the 15th year, the 20th year, we're not quite as good as we were with the Beast. So in this case, I would have built the Beast for myself instead of the Slayer. But I will tell you, for most people, that wouldn't be the case. We would compare both, which is usually what we do. How we normally will do this is when we find out what your needs and goals are, we will then design a couple policies to see which one's going to work best. Sometimes we let you pick, other times we're just going to look at the two and we're going to pick the one that has the highest cash value and the best design for your particular needs. We will show you two if you want to pick. Otherwise, we're going to design the best one for you. So that's the Slayer, almost always the best design when we're doing dump-ins. But let's move on to the 1090. And I know I'm going quick through this, but the 1090, which was the one that worked best without a dump-in, absolutely falls on its face with a dump-in. So here, I could only dump in $10,000. I couldn't even put 50 in. So now, in this design, if I wanted to only put $1,000 to the base, and it's actually $1,378. Now, because I put $1,378 to the base, and the PUA gets $86.22, because of the MEC rules, and I'm only allowed, based on this design, to put $10,000 in. But I wanted to put 50 in. You can't. It won't work. You will MEC the policy. And this one also requires a high amount of term just to put the $10,000 in. And that $225 in death benefit that we do on term has a drag of $441 a year. So this is your drag. And then the worst part is, when this policy is at its most efficient point, like I described before, our base drops to $1,378. Yes, the return is still good, but it's not as much. I'd much rather in the 15th year take $18,000 out versus $7,900 out. So the 1090 or the 9010 is not a good option in almost every scenario when it includes a dump-in. It's not because we just can't build it to hold the dump-in. Now here's the thing I don't like. This is a myth. There's agents out there that will tell you you can do this. Listen, I'm never going to say I'm the smartest guy and that I know everything, but we have worked directly with the carriers, with their team that designs these. They can't figure it out. So how is it that someone from another agency says,
Oh, we could do that. We can do a 90-10 with a dump in.
you can't? You might be able to get a little in, like I showed, 10, but you're not going to get a lot in. But, you know, I like to think that we're pretty innovative. And I like to think that I really am doing a pretty darn good job of pushing the envelope for our clients, for all of you watching this. So what we've done is we've done a first in the industry. We have gone out to one of our carriers with the sole goal of trying to design a policy that will allow for the highest early cash value, that of which we would get with only a 90-10, but with the strength, stability, and efficiency of the Nelson Nash model, the 60-40, or the 75-25, or the 65-35, where we have more of an efficient design. How do we take those two things and make one plan design? So this is going to be the last design I'm going to talk about today. We call this the Rock. I got to give you a disclaimer here. This design is proprietary and only available to the Money Multiplier and Money School BYOB. Our clients are the only ones that can get this design. And not all of our clients can get this design. This design only works for people that are putting more money into the policy. You can't be doing a small starter policy. It's got to have a dump in first. We got to be doing a sizable dump in. Let's just call it $25,000 and up. Okay, the higher the dump in, the better this plan works. And we got to be putting at least $10,000 per year into the policy for this to work. Not only that, this requires a dump in for the deposit, and it has to be approved as an exception by this particular insurance company. So I don't want you to get super excited about the Rock because it's not available for everybody. But if it is available for you and your goal is high early cash value with the maximum efficiency in the later years, boy, did we ever knock it out of the park. So again, let me just give you the inputs. 45-year-old healthy male. We're doing a $50,000 dump in the first year. And then we're only putting, we'll just call it 10 grand, but it's just for transparency, it's $9,999.48 because this plan is very difficult for us to design. So in designing this, it's not fun. But when we get it, it works really well. So how this design works, and I want you to stay with me because I just went over 4 other designs. This one is completely different. See, this design, in the first year, I'm going to put 10% into the base. So let's just call that, just for this is not exact, but let's just call that $1,000. Into the paid up edition, I'm going to put 90%. Let's just call that $9,000. So we remember that that's the best model for early cash value, but we couldn't do that model with the dump in. So then what we did is in the second year, so the first year, we're putting in the 50 grand and the 9,999. But in the second year, we're going to put the 9,999, but we're going to flip it. So year 2 through 10, we're going to take the base in the PUA and we're going to flip it. And we can do it any which way, but for this one, we're just going to say that the base is going to be 25% and the PUA is going to be 75%. But I can also design it so it's 60-40 if we really want the most efficient long term. It does require a term rider. So we do have a drag on here with the term rider, and that's because of the MEC 7 pay rule. The death benefit in this particular design is probably going to be one of the best ones. Now, there's some unique things about this, so I want to show that on this particular design with this particular insurance company, our death benefit in this one is going to be $1,196,142. See how that's way higher than the other ones? Well, it's because of the way this policy grows. And the other thing about this, the commission on this policy is going to be one of the lowest. It's going to be that of which the 90-10 was. That's how you have so much cash value early on. Our commission on this plan is going to be $28.9904. Why? Because we're only getting paid on 10% in the first year of the base. Because all of the switch happens year 2 through 10. You're only paid on first year premium deposits. Ding, ding, ding. We give, so you get. But look at the returns. In the first year, the 90% of the paid up addition gives us access to $55,000 of the 60 that went in. One of the best of all of them. In the fifth year, we put in 10 grand and we're taking 11,000 out. Our efficiency point is the third year in this design. Every year after year 3, we're printing money. Not really, but we're making more than what we put in. 10th year, we put 10 in, we take 14 out. The 15th year, we're going to drop down to 2264. So it's about 22%. So it's a little off, okay, but just take that. 2264, look at this. In the 15th year, I put 2264 in and I take 9,600 out. In the 20th year, I put 2,200 in, I take 11,518 out. Shut the front door. I want to finish up now by explaining what does all of this mean. You just saw a whole bunch of different plan designs. I went very in depth, and I know this is a long video, so those of you that are really interested, you could have just stopped after the first round. But let's take this to bonus. I talked almost exclusively about a product, a specially designed and engineered whole life, of which I called the machine, all in the effort of creating your own private banking system. But I never really went into what is the process. The process is called the infinite banking concept, and it is single-handedly the most important thing.
The most important thing.
When people ask us what we do, I say I teach people how to take back control of their money by showing them how to be the bank. By being the bank, I am teaching you the infinite banking concept, which is a process that does not involve a product. But we use that whole life product that I showed you because it's the most efficient place we can run our money through. Are you seeing what I'm saying here? We would never want to use the infinite banking concept using a bank account because you're not going to earn uninterrupted compound interest. Plus, you're going to pay taxes. Plus, it's not protected against judgments and liens, and there ain't no death benefit being paid out from a bank account. So, of course, it makes sense to use the machine, the specially designed whole life. And all it took, and I said this early on, is changing one thing. Change where your savings goes. Maybe you're 1099, maybe you're W-2. You're saving money and you have to be saving money for this to work. We're going to change and reposition that to a specially designed whole life, one of the many designs I just showed you depending on your needs and goals. How do we determine your needs and goals? You determine them. You're going to tell us what they are. Do we want to buy cars? Do we want to pay off debt? Do we want to buy real estate? Do we want to do private lending? Do we want to invest in different things? Do we need it for business or business loans? These are opportunities for your money to go to work. And you know, I have plenty of videos that show you how to get all the money back for every single car you'll ever buy, drive, and own. So let's just use a car as the example. The goal with the infinite banking concept, the process, is to take back the banking functions in your life. We have already changed one thing and repositioned our money, which gives us full control of the money and the ability to earn uninterrupted compound interest. Now, our goal from that point is to take the money out of the policy, clear it through a bank account, and then find somewhere for that money to go to work for you. Don't let the bank make your money go to work for you. You make your money go to work for you. So let's just, over here, let's use an example of a car. And I'm just going to quickly draw a car here. Let's just see. Not too shabby there. That's our car, okay? We're gonna buy a car. Now, all of you that own a car, chances are you took a loan out, or you leased it, or maybe you paid cash for it. Let's just pretend that you're going to take a loan for a car, but you're not gonna take a loan from their bank. You're gonna save up the money in your bank, and let's today buy a $30,000 car. So you've saved up cash value of roughly around $30,000. What we're gonna now do is we're gonna buy a $30,000 car. And in buying a $30,000 car, we're going to take a loan from our policy, which the insurance company is going to charge you interest on that loan. And remember, what was the loan the insurance company gave you? It was them advancing your death benefit to you early. That's all they're doing. They're giving you your death benefit early. They charge you interest on that loan. The interest you charge on the loan is simple interest. Your money is earning compound interest. And by today, right here, right now, you're earning more in interest and dividends than you're paying in interest. So you're already in a good place. You want to make more than what you pay. But if you understand compound interest versus simple interest, you'd understand how that really wouldn't even mean anything if you were earning less than what they were charging you, because your money never leaves your account and keeps earning. So let's go again. We then take the money from the bank account, we pay cash, we buy the car. You now own a $30,000 car. Most people stop there. You can't. With the infinite banking concept, you got to treat your money the same way you treat the bank's money. So if you took a loan from their bank, Ally, Bank of America, whatever bank, you would have to make monthly payments back to their bank. And those monthly payments would be interest and principal. So what are we going to do when we become the bank and when we take money from our bank as a loan? Well, we're going to treat our money the same way you treated their bank's money. So a $30,000 car would probably be on a 5-year note at 6% interest, about a $600 payment. Don't hold me to that number. You can do the math. So the other thing, before I show you the next part, I want to just take a second and I want to explain this slide. Look at this slide. This shows the difference between compound interest versus amortizing interest, or simple interest. So if you borrowed $50,000 at 6% over 25 years, the interest you'd pay is $46,645. But if you saved the same $50,000, earning 6%, and never put more money, the interest you would have earned compounding would be $164,593, meaning your 50 turned into 214. Now let me ask all of you a simple question. Would you rather have 164,593, or would you rather pay 46,645? Stupid question. You'd want both, right? Well, in this scenario, I'm showing you how to do exactly that, because you are the bank and you are borrowing from your bank, which is the policy. And in borrowing from your bank, you're going to pay interest on that loan. That's right. Not just the interest you're giving to the insurance company, but you're going to charge yourself the same amount of interest in this example that they would charge you on the car loan. So let's come back to the board. If the car finance company or whatever bank you borrowed money from the car was going to charge you 6%, well, then you would pay your bank back at the exact same 6%, which means you would set up a $600 bill pay per month or transfer back into the bank account. And we always suggest using a segregated bank account for your BYOB activity. Why? Books and records. But I'm not going to cover that today. I have plenty of other videos that cover that. Once the money hits the bank account, what we're going to do is we're going to get a form from the insurance company to set up a loan repayment to repay that death benefit that the insurance company lent you. So we take the $600 amount for the car payment and we put that money back into the policy. Now, in doing that, what we're doing is we're reducing the amount of the loan that you have with the insurance company. And every payment, every $600 payment you make back to the policy, the loan repayment, you're reducing the amount of the loan, which reduces the amount of interest you're earning. But you see, maybe you've already forgotten, your money never left the account. If you had 30 grand in your account, but you took a loan for 30 grand, you still have 30 grand earning interest. Go back to the slide real quick. Check this out. Remember, if you had 50,000 earning interest, you made 164,000. Compounding beats simple interest, always. So back to the board, your money continually earned interest, but you were an honest banker and you practiced the infinite banking concept, the process, and whatever the car payment would have been, you paid back to your policy. But here's the cool part. I know no one watching this video right now, when you make your car payment to their bank, I don't care if it's the car company's finance company or the bank you borrowed from, can you go back to them and ask for that $600 back every month? No, that's stupid. That money's gone forever.
That money's gone forever.
You just got yourself a depreciating car in the driveway. But now because you changed one thing and you added one step, you are the bank. You borrowed money from your bank, which means when you pay your bank back, how much money goes back into your policy, which i.e. is your private bank, every month? $600. How much money do you have to use the next day after you make the $600 car payment every month? $600. You're the bank, folks. If that didn't just have an aha moment, then I don't know what to say. You got to go back and watch this video and a lot of other ones to get the hang of it, because I didn't do much. I changed one thing and added one step. And it didn't require you to work any harder, any longer, or take on any risk. It just put you in control of your money. It put compound interest behind all of your money. Think of it as a tailwind on an airplane. We just added a tailwind to all of your money, and that's how this works. I don't care if it's buying cars, paying off debts, investing in real estate, loaning money. It's the same thing. It's a circle. And in the middle is you in control. So folks, I hope you really enjoyed this. I literally peeled the curtain back. A lot of other people in the business did not want me to do this video. And I will receive lots of haters, but you know what? For the haters I get, I helped all of you understand how the infinite banking concept works and how the machine that we use to go into this process really benefits you. And again, it's time for you to take back control of your money. And I promise you, no one cares more about your money than you. So I hope this video helped you. And if you're interested in setting up a policy, we are happy to help you. Book a call by going to chrisnaugle.com. I'll put it right down in the description. chrisnaugle.com. You can watch the 90-minute video to really get a recap of this, and then book a call with my team, and we'll help find out what your needs and goals are, and we'll solve whatever problems you have using this concept. And if you really love this video, do me a favor and give me a like. Heck, subscribe to this channel and click that little bell, because I put videos up every day and I want you to benefit from them. And one more thing, if you enjoyed this one, then you'll probably love this video called BYOB. Thanks for joining me. I'm Chris Naugle. We'll see you next time.